It is fascinating to watch the market try to find its footing when it suddenly realizes it has to reprice entire sectors at the exact same time. Welcome to the Working Thesis. I am Maya, and joining me is Theo.
Hey Maya, repricing is exactly the right word. We are looking at a market aggressively trying to rediscover what things are actually worth. But it is not using a single formula. It is splitting the market and applying completely different logic depending on what you sell.
Right. We have two massive sectors, software and memory, going through this brutal price discovery phase right now. But the tape is asking them two completely different questions. With software, the market is purely asking, did your outlook improve? The time frame is incredibly short. They are looking at the next quarter's guide.
And then you look at memory and storage, and the question is entirely different. Nobody is arguing about next quarter. The market is asking, how long does the margin peak last? The time frame they are arguing about is the next several years.
Two sectors, two questions, two totally different time frames. Let us dig into how that played out today.
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Looking at the closing numbers, the broader indices were relatively subdued. The S&P 500 closed at 780,996, down 0.18%. The Dow finished at 53,885.10, dropping 0.85%. The Nasdaq Composite closed at 26,348.35, down just 0.06%. And the Russell 2000 closed at 3,001.55, down 0.58%.
The VIX pulled back a bit, closing at 15.5, down 4.17%. In the bond market, the 10-year Treasury yield moved to about 4.7%, rising roughly 6 basis points on the day. That yield move has a few plausible contributors, including positioning ahead of payrolls, oil, and a massive new bond proposal from Alphabet. They are looking to raise up to $25 billion in a bond sale, reported as up to 10 tranches with maturities from 2 to 40 years. Initial price guidance on the 40-year is around 155 basis points over treasuries. To be clear, that $25 billion is a proposed maximum, not a completed deal. And initial price guidance is not the final spread.
The software ETF, the IGV, closed at 99.42, down 1.87%. But underneath that mild drop, there was absolute carnage. Before we get to software, let us quickly separate the two oil stories driving WTI crude, which settled just under $78, up about 3.7%.
Right. Coverage is merging two distinct things. First, Iran and Oman finalized an understanding on shipping lane coordinates through the Strait of Hormuz. That is bilateral. The U.S. is not a party. It is temporary, initially 2 to 4 months, and a final joint statement was still pending.
Separately, Iran's parliament is still reviewing a domestic bill that would bar U.S. and Israeli-linked vessels and charge others up to 7% of cargo value. It has not passed. It is not law. There is no signed international agreement. The tape is pricing a disruption, but whether a domestic draft bill becomes reality is a different question. Let us move to software, where the illusion of a calm market completely breaks down. Today, 3 very prominent software companies closed down roughly 19% on the exact same day.
A 19% haircut is what you expect from a catastrophic macro shock.
But this was not a macro shock. AppLovin closed down 19.66%. HubSpot fell 19.1%. Datadog dropped 19.03%. 3 massive names losing nearly a fifth of their value for 3 different reasons. And yet, the IGV index fell only 1.87%.
When you see 3 darlings get obliterated but the index barely registers it, your brain assumes there was a massive rotation to keep the index afloat.
That is the standard narrative, but that is not what the math tells us.
Let us do the arithmetic on air. AppLovin makes up 3.62% of the index. Falling 19.66% means it contributed negative 0.71 percentage points to the index.
Datadog is a 3.26% weight. Falling 19.03% contributes negative 0.62 points.
HubSpot is about 0.6% of the index. Falling 19.1% shaves off negative 0.12 points. Add those up. 7.5% of the index by weight produced about 1.45 points of decline.
Out of a total decline of 1.87 points, roughly 78% of the entire move in the software index came from just 3 stocks.
People assume other names rallied to offset this. They didn't. The rest of the index did essentially nothing. Palo Alto, Oracle, ServiceNow, Adobe, Cadence, Intuit, Synopsys, Salesforce, they all netted out to roughly flat.
The only real offset came from Microsoft. It rose 2.54%. At roughly a 9.5% weight, it added about positive 0.24 points on its own, roughly canceling out the declines in Salesforce, Palo Alto, Intuit, and Oracle combined.
The interpretation here is crucial. This is not a sector derating. This is stock-by-stock revaluation, which is exactly what refining valuations looks like. The index concealed it through dilution and indifference, not rotation.
Let us look at the individual sins. Datadog reported before the open, and here is what is incredible. They did not miss. Datadog beat and raised.
Q2 revenue was $1.121 billion, up 36% year over year. Non-GAAP EPS was 65 cents. Non-GAAP operating margin was 23%. Free cash flow was a massive $279 million.
They even raised full-year guidance. Revenue went up to $4.45 to $4.47 billion, and non-GAAP EPS up to $2.50 to $2.54, and it still closed down 19.03%.
Why? It is all about the slope. Q2 grew about positive 35.6%, but the Q3 guide midpoint implies about positive 28.7%. And the full-year midpoint implies Q4 slows to around positive 25%. Management also disclosed that a major AI customer's usage declined in the second half.
At the $229.29 close, you're looking at roughly 91 times forward earnings on the company's own full-year EPS guidance. Datadog beat, raised, and was still cut by a fifth. The market didn't reject the results. It repriced the trajectory. You have AppLovin, down 19.66%. Revenue grew 53%. EPS beat by a penny.
But revenue came in roughly 1% below consensus. That was enough to lose a fifth of their market cap.
For fairness, management said the quarter lacked a major model upgrade, and the next improvement shipped in early July after the quarter closed. It is a timing issue, not a capability regression. But in this market, timing is everything.
HubSpot is the cleanest teaching case for what is happening. They beat on both lines. Revenue was $911.7 million, up 20% year over year, beating consensus by about 1.5%. Non-GAAP EPS was $3.26, beating by about 8%.
Non-GAAP operating margin improved to 20.3%, up from 17%. They repurchased $531.9 million of stock and authorized $1 billion more, and it fell 19.1%.
Because of the guidance, Q3 revenue was guided to about $924 to $925 million. That is 14% growth, down from 20% in Q2. Full-year guidance was trimmed to about $3.68 billion. Net revenue retention was 102%, down about a point year over year. Quarterly net customer adds were guided to 5,000 to 6,000 versus 7,000 in Q2.
Management cited budget scrutiny, longer sales cycles, and customer downgrades. Customers want to pilot AI agents with their own data before committing, which lengthens the sales process. The quarter was good, the future got worse, and the market only priced the second one.
Now, today's tape was pricing last night's news. Then 5 more companies reported after today's close: Atlassian, Cloudflare, Applied Optoelectronics, Wheaton Precious Metals, and MP Materials. Half of today's news isn't in today's prices yet.
And this is the comparison I keep coming back to. Put Cloudflare and Datadog side by side. On the headline, they are almost the exact same quarter. Both grew revenue about 36%. Both beat on revenue and EPS. Both raised full-year guidance.
But Cloudflare rose about 16% after hours, while Datadog closed down 19.03%. Same headline, opposite outcome. What actually differed? First, Cloudflare's Q3 revenue guide came in about 2.1% above consensus, while Datadog's implied clear deceleration. And Datadog disclosed that major AI customer reducing usage.
Margins are structured differently too. Datadog's non-GAAP operating margin is 23%, and they are slightly GAAP profitable. Cloudflare's non-GAAP margin is 13.8%, and they still posted a GAAP operating loss of $205.7 million. They went in with very different valuations and positioning.
Cloudflare's exact numbers. Revenue $696.1 million, up 36%. Non-GAAP EPS 29 cents. Full-year revenue guidance raised from $285 to $2.813 billion, up to $2.864 to $2.870 billion. And full-year EPS from $1.19 to $1.20, up to $1.25 to $1.26. Q3 revenue guided to $736 to $737 million.
After hours, it went to about $330.50 from a $284.43 close, about positive 16%. On the company's own full-year EPS guidance, that after-hours price is roughly 260 times forward earnings. The market is not paying for the beat. It is paying for the slope of what comes next, and it will pay 260 times earnings for the right slope.
We also need to slow down on Atlassian. It closed the regular session at $110.17, down 2.78%, then rose about 33% after hours.
Atlassian's FY27 guidance as printed looks bad. Total revenue growth is guided to about 13%, down from 28%. Non-GAAP operating margin is guided to about 25% versus 36% in the most recent quarter, though we should note that 36% is a quarterly figure, not a full-year number.
But look inside it. Cloud revenue growth is guided to about 25.5%, and Q1 cloud is guided to about 28.5%. The data center line is declining because they are deliberately migrating customers off self-managed licenses onto cloud. The shrinking line is being switched off on purpose.
And the quarter was strong. Revenue $1.77 billion, up 28%. Cloud $1.21 billion, up 31% and accelerating. ARR $6.61 billion, up 23%. Remaining performance obligations $4.82 billion, up 44%. GAAP operating margin was positive 12%, up from negative 2%. Free cash flow was $475 million. The company says its Rovo product is now used by over 80% of the Fortune 500.
The lesson pairs perfectly with HubSpot. A guidance number can fall for a good reason. HubSpot's guide fell because demand softened. Atlassian's fell because it is retiring a product line. Same direction on the page, opposite meaning.
The rule is clear. The market has stopped paying for good results. It pays for a better outlook. FactSet data shows S&P 500 companies that beat this quarter have moved positive, 0.1% on average, against a 5-year average of positive 1%.
But keep two exceptions in mind, because they make the rule credible rather than glib. Western Digital beat on revenue, beat on earnings, guided above expectations, and fell 13.03%. Partially, it had run up about 18.7% in the 4 sessions before the print. It was a good quarter with nowhere left to go, though we shouldn't pretend that is a complete answer.
Second, Arista beat and raised and popped 11 to 13% after hours. But by the next regular session, it held only positive 3.56%, and the session after that, it fell 2.53%. The market gave the gain back. Do not describe this as a clean win.
Act 2 begins with memory, which is asking a different question entirely. Memory and storage had a brutal session after strong results. SK Hynix down 10.37%. Western Digital down 13.03%. SanDisk down 6.81%.
SanDisk's quarter was extraordinary. From their release, revenue $8.97 billion, up 372% year over year. Non-GAAP gross margin 84.6% versus 26.2% a year ago, an improvement of over 58 percentage points. Non-GAAP EPS $39.25 versus 29 cents a year ago.
Full-year revenue $20.25 billion, up 175%. Data center revenue up 437%. A new $14 billion buyback authorization, bringing the total remaining to $15.5 billion, and the stock fell.
Look at the forward valuation. Next quarter guidance is EPS of $44 to $46. Annualize that, and against a $1,258.58 close, you get roughly 7 times forward earnings. Nobody in memory is arguing about next quarter's guide. The argument is about duration.
So here is the puzzle. A company growing revenue 372% with 84.6% gross margins trades at about 7 times forward earnings. Either the market is asleep or it doesn't believe those earnings last.
The bare evidence comes from the company's own release. Sequential revenue growth came approximately 1/3 from higher volumes and 2/3 from higher pricing. 2/3 of the growth is price. Price is the thing that mean reverts. Volume sticks.
Second piece. SanDisk guided next quarter's gross margin to a range of 83.0% to 85.0%, and it just printed 84.6%. The top of the range they are guiding to is 0.4 of a point above where they already are. That is about as close to signaling a peak as management gets.
But the bull evidence is strong, too. Long-term supply agreements lock in volume and pricing years ahead, improving visibility. And if AI demand keeps compounding, not just in data centers, but at the edge, in phones, PCs, and cars, where memory content rises, the runway extends.
The honest framing. A 7 times multiple prices a fast rollover. It prices months. But contracts and AI demand make it plausible the peak runs for several years. If the peak lasts years, 7 times is the wrong multiple. We lean toward delayed rather than repealed. The cycle has been scheduled, not abolished. But we could be wrong. This is just one lens.
It is like a bumper harvest season. The question was never whether prices come down eventually. It is whether this season runs 1 year or 4, and whether you are being paid enough to wait.
The tells to watch. Whether the growth mix shifts from price back toward volume. Whether gross margin guidance ranges start stepping down quarter over quarter. Whether edge memory content actually rises, and new capacity arriving, including from Chinese producers. New capacity still arrives eventually, just later.
Briefly, Applied Optoelectronics posted its 5th consecutive record quarter. Revenue $191.9 million, up 86% year over year and up 27% sequentially. Data center revenue $107.7 million, up 140%, now 56% of the total. 800G revenue was $12.8 million, more than doubling sequentially.
Capacity goes from roughly 200,000 units a month now to about 650,000 by the end of 2026 to about 930,000 by the end of 2027. CEO Thompson Lin said, "Demand to support next-generation AI infrastructure remains so robust that our near-term revenue is bounded almost entirely by production capacity and key component availability. This is a supply constraint, not a demand problem."
MP Materials reported after the close, revenue $108.5 million, up 89%, ahead of expectations of about $96.9 million. Adjusted EBITDA positive $28.5 million versus a loss of $12.5 million a year ago. NdPr sales volumes up 127%.
One caution. As of today, there is no enacted U.S. ban on Chinese optical transceivers. It remains a reported draft with no published rule.
Bringing it together, Software's question is about next quarter. HubSpot beat on both lines and fell 19% because the next quarter looked worse. Atlassian's headline guidance was cut nearly in half, and it rose about 33% after hours because the part being cut is a product it is retiring on purpose. Read what's inside the number.
Memory's question is about the next several years, and it is genuinely unresolved. Alphabet's bond deal matters beyond today. The big cloud providers are increasingly funding AI infrastructure with external debt because capital spending is running ahead of operating cash flow. Forecasters expect that free cash flow squeeze to ease in 2027 and improve into 2028. But that is an outside forecast, not company guidance, and it depends on AI profits eventually exceeding CapEx.
A closing thought. When an index moves 1.87% and contains 3.19% collapses, the index is not describing the market. Averages hide exactly the thing you need to see. Keep an eye on those memory tells. That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.